Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, June 1st, 2026. We're Elena and Marcus.
And looking at today's proprietary updates, it was definitely a heavy session.
Yeah, it really was. So before we get into the weeds, let's just lay out the three critical themes from our daily desk data. If you are managing risk or positioning capital, these are the three dynamics you need to understand right now.
Right.
First is the geopolitical rate shock. We saw a really violent intraday tug of war in yields, and that was driven by a mid-morning Iran headline colliding with a stagflationary ISM manufacturing print.
Which is a tough combination.
Exactly. The second theme is extreme equity bifurcation. The S&P 500 extended its record streak today, but underneath that, we tracked a massive historic rotation into software.
Yeah, alongside some severe punishing of the REIT-sensitive sectors.
Right. And third is what we're calling the energy yield nexus. We're closely monitoring this tightening correlation between WTI crude spikes and front-end rate repricing and, what that means for the broader economic regime going forward.
Moving to today's data, we have to start with the dominant macro driver, which was that aggressive repricing of interest rates both domestically and internationally.
Right. The Treasury action was just exceptionally volatile today.
It was dictated almost entirely by that Middle East shock intersecting with the domestic inflation data. If you look at our latest run of the intraday chart, the 10-year Treasury yield, it actually spiked to 4.51% mid-morning.
Which is a sharp, sudden move.
Very sharp.
Yeah.
And that surge directly followed reports from Tasnim that Iran would halt U.S. exchanges and potentially blockade the Bab el-Mandeb region.
But we didn't state those highs, right? There's a distinct reversal later in the day.
Correct. The 10-year pared back toward 4.455% in the afternoon. And that was following some positive de-escalation comments from President Trump regarding Lebanon. But the real stress, the actual pain point for investors today, was heavily concentrated at the front end of the curve.
Right. The front end led the losses.
Exactly. The 2-year Treasury peaked at 4.08% before settling down around 4.035%. And this wasn't just a domestic phenomenon. Our daily desk data shows German bonds bear flattening aggressively in early trading.
Right. And let's unpack bear flattening for a second. So if you're looking at your portfolio trying to make sense of the bond market, that basically means short-term interest rates are rising faster than long-term rates.
Right, which is a key indicator.
Right. It's a direct signal of immediate economic stress. The German 2-year was up roughly 6 basis points very early in the session.
Correct. And when the European front end is under that kind of intense pressure, it weighs heavily on U.S. treasuries. It's all connected via global capital flows. Even before that, Iran news amplified the move stateside.
Well, let's actually apply the first principles rule right here. Because for a non-professional investor reviewing today's data deck, we need to walk through the direct transmission mechanism.
Yeah.
Like, how exactly does a geopolitical headline out of the Middle East mechanically translate into higher yields on a U.S. 2-year Treasury? Walk us through a clear, real-world analogy.
Okay, so think of the global economy like a massive logistics and trucking company.
Okay.
When oil prices spike because of a sudden bottleneck or a blockade in a major Middle East transit choke point, every single truck in that fleet instantly becomes more expensive to operate.
Right, the input costs just shoot up.
Exactly. And the trucking company cannot just absorb that loss forever, so they pass that higher cost down to you, the consumer.
So it acts as an immediate tax.
Right. And when the cost of energy rises across the board, your baseline inflation expectations rise in tandem. Now, because the Federal Reserve's primary mandate is price stability, when they see inflation expectations surging,
They have to step in.
they do. It mechanically increases the probability that the Fed will step on the economic brakes by implementing a rate hike to cool things down.
Right.
And since the 2-year Treasury is highly sensitive to the Fed's next move, as the market prices in a higher probability of a Fed hike, those front-end yields mechanically rise to reflect the tighter policy path.
And the timing today was just brutal because that geopolitical inflation shock hit the terminal on the exact same morning we received the ISM manufacturing data,
Right.
which reinforced the exact same hawkish narrative.
Indeed. The ISM manufacturing headline number actually beat expectations. It came in at 54.0.
Right.
But the critical detail in today's proprietary updates isn't the headline number. It's the prices paid subindex, which surged to 82.1.
which is a massive jump.
It is a severe jump. This level explicitly echoes those post-COVID inflation dynamics that dealer desks really thought were fully resolved.
Yeah, that prices paid metric skyrocketing to 82.1 is the crucial variable here. It basically gives the Federal Reserve explicit cover to maintain a hawkish bias.
Exactly.
In fact, looking at our floor data, we tracked the CME FedWatch implied probabilities, and we saw December hike odds jump to 43% intraday.
So the market is aggressively pricing in the reality that inflation is simply not tamed yet.
Right. On that point, this brings us to the most visible tension in the market today. We've got this stagflationary undertow in rates, higher yields, higher inflation data, higher energy costs.
Yeah.
And yet, the S&P 500 closed at all-time highs for the 8th consecutive session. But the broader index level is masking some of the most extreme equity bifurcation we have seen all year.
It really is.
If you are holding a diversified portfolio, you likely felt the pain today despite the record headlines. The market breadth was remarkably poor. 9 of the 11 major sectors actually declined today.
Right.
The rate-sensitive sectors were actively punished. Utilities tracked via the XLU were down 2.7%. Real estate was notably negative, and the small-cap Russell 2000 lagged heavily.
Yeah, essentially all the index gains were attributable to just two sectors, technology, the XLK, and communication services, the XLC.
And the specific flows driving this concentration are highly notable.
Right. Our desk's commentary highlights a very violent thematic rotation today. Software just completely decoupled from the broader market. It outperformed with a 7.9% gain.
Which is huge.
It is. To put the velocity of that move in perspective, this marks the largest two-day stretch of outperformance for the software sector against the broader market in over 25 years.
But looking at our data deck, this doesn't show fundamental conviction buying.
No.
It looked panicked. This wasn't investors deciding software balance sheets suddenly looked pristine overnight. It was essentially a massive short squeeze, right?
Correct. Our proprietary flow data confirms this was not driven by fundamental buying. The velocity of the move was heavily driven by hedge fund and long-only short covering, alongside the rapid closing of underweight positions.
So institutional investors were just caught offside.
Exactly. They expected a continued downturn in software, and when the momentum suddenly shifted, they had to scramble to buy back shares to right-size their portfolios and, cover their shorts.
So explain the mechanics of how that was funded, because this is where the market plumbing gets really important for the average investor to understand.
Right. Well, when institutional funds are caught short and they need cash immediately to cover those positions, they can't easily sell illiquid assets.
No.
So they are forced to sell their most liquid winners.
Yeah.
And the institutional consensus basically use the Magnificent Seven as an easy source of liquidity.
Right.
So the Mag 7 actually lagged today because funds use those highly liquid positions to raise cash quickly and finance this rapid rotation into software.
Yeah, that makes sense. We also saw some significant developments on the hardware side today, largely driven by the Computex conference in Taipei. We have to specifically name NVIDIA here.
Right.
NVIDIA rallied roughly 5% today after Jensen Huang unveiled the RTX Spark Superchip.
Which is targeting the PC market.
Exactly, a market currently dominated by Intel and AMD, and both of those stocks were heavily pressured today as a result.
Okay.
And then we have Micron. Micron surged 7.5% today, crossing a $1.17 trillion market cap.
The momentum in the semiconductor and memory space remains a dominant force globally.
It really does.
We noted the South Korean Kospi Index actually surged over 4% overnight, and that regional market action was almost entirely driven by the AI memory chip supply chain reacting to broader demand forecasts.
Yeah, but I do want to push back a bit on this perpetual technology bullishness, because of a critical after-hours development we saw with Alphabet.
Right, the equity raise.
Alphabet announced an $80 billion equity raise specifically for AI infrastructure. Does this massive dilution signal that AI capital expenditures are transitioning from an exciting growth tailwind into a heavy balance sheet headwind?
Understood. Let's look at the input costs fueling this environment, because that Alphabet equity raise is inextricably linked to the physical constraints of the AI build-out.
Right.
And the commodity complex, which was the epicenter of today's geopolitical volatility, serves as the foundation for these exact infrastructure costs.
Yeah, the oil spike was definitely the most immediate macro shock. WTI crude jumped nearly 8% intraday as those headlines regarding Iran and the Strait of Hormuz hit the terminal.
It was a very aggressive spike.
It was. It ultimately settled at 5.4% and 92.62. Brent added 3.5% to 95.25.
Hmm.
If oil stays elevated, that inflation pipeline we discussed earlier just becomes deeply entrenched.
Right. And looking at the industrial metals side, copper gained 2.7% today.
Which connects directly back to what we just talked about.
Exactly. It connects directly back to the AI infrastructure build-out we analyzed with Alphabet. Building massive data centers and funding the necessary power grid expansions, those are intensely copper-dependent endeavors.
Yeah.
When a single company is raising $80 billion for physical infrastructure, a significant portion of that capital is ultimately chasing industrial metals and energy capacity. It basically creates a structural bid for commodities.
But there's a major cross-asset contradiction in today's data deck regarding hard assets. Gold actually dropped today. It fell to $4,481 an ounce. Why would the ultimate geopolitical safe haven asset decline on a day when Middle East tensions were actively threatening the Strait of Hormuz?
It seems counterintuitive.
Right, you would expect gold to rally hard on war headlines.
It comes down to how gold competes with other safe assets in a rising rate environment. Today, the US dollar firmed. The DXY index reached 99.178.
Right.
And simultaneously, as we discussed in the macro segment, real yields spiked significantly. The market didn't treat the Iran conflict as a system-breaking financial crisis. They treated it as an inflation and rate shock.
So it's an opportunity cost problem for the investor.
Exactly. In an environment where the US dollar is strengthening and treasury yields are climbing, investors favor dollar-denominated yield over precious metals.
Because gold offers no yield.
Right. If you can get over 4% on a 2-year treasury practically risk-free, the opportunity cost of holding a non-yielding asset like gold simply becomes too high, even with geopolitical risk in the background.
Indeed. We need to synthesize this daily data run across rates, equities, and commodities. The core question for institutional consensus right now is, what do all these simultaneous moves suggest about the broader market regime?
Well, the defining cross-asset relationship right now is the 30-day correlation between WTI crude and the 2-year Treasury yield. Our latest run shows this correlation is currently sitting at a multi-year high.
Right. They are moving in lockstep.
They are. This means every geopolitical development in the Middle East is instantly transmitting into U.S. monetary policy expectations. Oil dictates inflation, inflation dictates the Fed, and the Fed dictates the discount rate for every asset class you own.
And yet, despite that tightening noose on the discount rate, we are operating in a conditionally risk-on environment defined almost entirely by AI exceptionalism.
Right.
The market is demonstrating a clear willingness to pay record multiples for AI-driven growth. NVIDIA, Micron, the broader software sector, they're being rewarded because their current earnings growth is currently powerful enough to offset the headwind of a higher discount rate.
Correct. But the critical takeaway for anyone analyzing today's data deck is that the rest of the economy is suffering under the weight of higher rates and elevated energy costs.
Yeah, we see the cracks beneath the surface very clearly in the breadth data.
We do. The steep drop in utilities, the persistent lag in the Russell 2000, and the contraction we saw in the ISM employment sub-index.
Right.
All of that indicates that companies without a direct AI tailwind are actively feeling the pressure of this restrictive monetary environment. Small caps just cannot outrun a 4.5% 10-year treasury.
Which brings us back to the Alphabet equity raise, because it really bridges the gap between those two worlds.
It does.
I mean, the sheer cost of scaling artificial intelligence might eventually clash with this higher for longer rate environment. It forces us to ask when investors will have to choose between funding AI distribution and acknowledging basic economic gravity.
Right.
If the cost of raw copper, crude oil, and debt financing continues to rise, the physical economy might eventually set a hard speed limit on digital expansion.
To quickly recap today's core takeaways from our proprietary updates. Rates reacted sharply to the spike in oil. The software sector squeezed significantly higher on aggressive short covering, and the broader market remains wholly dependent on AI exceptionalism to mask underlying economic rate sensitivity.
Thank you for listening to Market Polls by Orestes Capital. We're Alina and Marcus. We'll be back tomorrow with the latest market color.